Good afternoon. My name is Mark Wisniewski, and I am the portfolio manager for the Diversified Bond Fund and the Credit Income Opportunities. And I thought I would take this opportunity to talk a little bit about last year, what happened, what went well, and a little bit of my outlook for 2018, how we're positioning the portfolio, and exactly what I think is going to happen this year. So why don't I start with last year? It was a complete surprise, the strength of the Canadian economy last year. I think it was a huge surprise for the Bank of Canada in that the dialogue from them earlier on in the year was that they weren't going to raise interest rates, and they subsequently ended up raising interest rates twice, which was a real surprise. The other big surprise was the strength of the global economy, especially Europe, and the fact that most central banks went from an accommodative monetary policy to basically signaling that they were going to start to ease off of that and begin to raise rates. Because all of this central bank talk was accompanied by higher global economic growth, it was a very, very favorable environment for risky assets, equities, credit, high yield, and consequently they performed quite well. So we ended up generating just a little bit better than 5% in both of our funds, with very, very low volatility, somewhere around 3.5 in one fund and 3.7 in the other. So we're quite happy with that return and volatility, given it was and did start off to be what we thought was going to be a fairly challenging year. So some of the attribution, I want to talk about some of the attribution in the fund from 2017, but just by starting off and say that our objective is always to deliver income, but with less exposure to what we think is the biggest risk, and that's higher interest rates. So we really benefited because we use much less duration than typical bond funds use. And consequently, we weren't that impacted by that move higher in interest rates. And the way that we do that is there's a few ways, but the most significant way we do that is by using option strategies to mitigate interest rate risks. So we use big liquid ETFs, and we do options on those to put tail risk hedges for either interest rates or movements in credit. So we initiated some of those, which obviously helped us quite a bit as interest rates did move up finally in December. The other thing is that we don't own any government bonds, and we don't own government bonds primarily because typically the reason you wanted to have government bonds is because they were safe, and they are safe, but unfortunately they're not riskless. And nowadays with interest rates, although they're a little bit higher, with interest rates as low as they are, I look at government bonds as being really risky in that you don't get paid a lot of interest, and you need to take a lot of duration risk on them to get paid anything. So consequently, I find them to be a little bit risky in the current environment. We prefer credit, and our exposure to credit is primarily investment grade or high yield. And one of the things that worked quite well for us last year was our exposure to investment grade and high yield, because I said it was a fairly favorable environment for credit equity markets. Lastly, one of the things that we've been adding to our portfolios are preferreds. We haven't owned them in years, but last year we started adding to them primarily because of their value. We found them to be really cheap, and we were adding preferreds that were yielding anywhere from 4.75% to 5%. Some of them had 5% floors, and they had much generous resets than what they had in prior years. So consequently, we were seeing much higher yield, or had the ability to add much more yield to the portfolio than just using basic fixed income. But to be clear, our exposure to preferred shares was somewhere between 6 and 10%. It's not a significant part of the portfolio. So I want to talk next a little bit about my outlook for 2018, and one of the things that I talked about earlier is that it seems very, very clear now that central banks are being very aggressive in signaling the fact that there's going to be less easier monetary policy. So first of all, we had the Bank of Canada raise interest rates already this year. I think they're going to raise interest rates 2 more times this year. We have the Federal Reserve that's probably going to raise interest rates in March, and the consensus is about 3 more times. So there's a potential for the Fed to raise rates 4 times this year. The other thing that we're seeing is there's a continuation of higher global economic growth. So the global economy last year grew probably somewhere around 3.5%, and the projection this year is for better than 4%. So the world is growing at a much higher rate than they were before. And then the other thing is that we are seeing now is the return of inflation. So we used to have much less global excess capacity. So most economies were operating with a fairly large output gap, and consequently, as you'll recall, most economies, countries, were reducing, deflating their currencies and trying to export their way out of it, which meant that a lot of developed economies were importing deflation. That's starting to change primarily because everybody's output gap is starting to close because demand is starting to improve. The other thing is we are seeing record low unemployment in all the developed economies. We have low employment here in Canada, the United States, Europe, and certain parts of Asia. So with that, we're starting to see higher wage pressure, which will at some point have to be passed on to prices. The next thing is, because global growth is higher, we're now seeing a rebound in commodity prices. So oil prices are higher, base metal prices are higher. And the last thing is that we're hearing a lot of discussion about trade. So Trump's talking about NAFTA. Different countries are talking about their trade rules and the role of trade. So that whole movement of globalization that we saw for so many years that led to lower prices is being challenged right now. So I think that the more trade talk we get, the more changes in trade we get, that becomes more inflationary as well. So again, I think this year we're going to see higher interest rates. So with that, what we're going to see is higher interest rates because obviously inflation is a component of interest rates. I think we're also going to see a flattening of the yield curve, and lower rated corporate credit is probably going to come under pressure as we approach what I think is the end of the business cycle. And lastly, and I didn't write this just now, I wrote this in December, we think volatility is going to return. So higher interest rates are going to lead to higher volatility, and lo and behold, what we've seen is much higher volatility. So I just wanted to talk briefly about interest rates and why we think interest rates have to go higher. So the first thing I talked about was the fact that central banks are signaling globally that they want interest rates higher. So again, I think the Bank of Canada will probably raise interest rates a total of 3 times this year, and I think there's a chance that the Federal Reserve raises rates 4 times there. So we're going to get a higher bank rate. So the bank rate in Canada and the US is probably going to be 2% or better. The other thing is that we're starting to see a return of inflation and inflation expectations. So one of the charts that I like to look at is the Federal Reserve's 5-year forward break-even inflation, and you'll see that's moved up higher than 2% right now. So inflation expectations are starting to move up. The next slide is real rates, and you'll see that the rate on real rates is starting to move up. It's still a little bit ways from the 1% long-term average, but having said that, it's moving off what was a very, very low base. And the last thing is term premium. And term premium is simply the extra yield that you get paid for going further out the yield curve. And because we had central banks that were very active in buying bonds, what they were doing is taking the risk premium out of the market and shrinking that risk premium because they were buying a lot of longer-term bonds. Well, the Fed is reducing their bond purchases. Most governments are now, you'll see in the US because of tax cuts and their changes to the debt ceiling, most economies now are starting to issue more bonds and central banks aren't buying them. So what we're starting to see is a return of a higher risk premium. So that risk premium was extremely negative. It's starting to move into positive territory. So if I look at if I look at a rough approximation of the components that create yield, their inflation expectations, their growth, and their term premium. And all of those things are currently increasing. So bond yields now have increased since December to the tune of 40 to 50 basis points. So I would expect that in Canada, we're probably going to have 10-year rates that are somewhere between 2.5% and 3%. And I would think that 10-year rates could be somewhere around 2.75% to 3.25%. So interest rates are moving higher. I also like the Canadian dollar because I think global growth will be very supportive to commodities, which will be a very good story for Canada. So I think the Canadian dollar is probably going to approach something like 1.2 or conversely 83 cents. So we're really very constructive on the Canadian economy. But to be clear, rates are going higher, but not significantly higher. I mean, the move in 10 years up to somewhere on average of 3% or 2.75% for 5 years isn't significantly higher. I mean, but 50 basis points in this low rate environment is considerable right now. So what we've done is we've reduced our duration materially. So to start off the year, we've taken our duration right down, and we feel that that's probably the best place to be to start off the year. Our expectation is that somewhere in the first part of this year, potentially the first quarter of the first half, we'll probably get a bump of 25 basis points higher in interest rates. And at that point, we'll look to do something with our duration. So the next slide I want to talk a little bit about is slide 10, the slope of the yield curve. And I'll explain why this is this is one of the things that's very important to us. It's primarily because, as you know, when the yield curve starts to invert, it typically becomes a signal of recession and a slowing economy. So if by look on the slide on the left side, you can see that our curve, the 3 month to 10 years, is starting to flatten. So the takeaway from that is it's not inverted yet, it's not flat yet, and it is starting to move from a very, very steep point. But the message here is that the yield curve is starting to flatten. And with that, the risk of recession now is somewhere around 10%. So that's not significant, but all that tells us is that we are starting to approach the end of the credit cycle, and it's a yellow light. It indicates to us that recession is somewhere on the horizon. So when we think about credit, credit is going to be like equities. As we get to the point where the investing population feels that we're going into recession, then they start selling securities. So we're not there yet, but we're saying that this is something that we need to be cognizant of. So on slide 11, one of the things that we're looking at, one of the things that we look at is credit spreads. And as you can see, credit has moved extremely tight. Credit spreads are now down to all-time lows. So it's time to think about the type of credit exposure that one wants. And I would say to be defensive with credit spreads as tight as they are right now, we prefer to be more invested in investment grade and less invested in high yield. So we'll be reducing our exposure to high yield and have been reducing our exposure to high yield in favor of both cash and investment grade. So in 2018, portfolio positioning is going to be key. So our focus is going to continue to be income generated from corporate credit, because that's where we think the best place to be is. So our duration, as I explained earlier, is really, really low. So the diversified bond fund has about 1 year of duration, and the credit income opportunities is very close to zero. And I'll explain a little bit how we get duration to zero in a second. But having said that, the diversified bond fund yields 3% with 20% cash, and the credit income opportunities yields 5% with zero duration. So those are really, really important numbers, primarily because we have little exposure to interest rates, but we're generating a very, very good income in spite of that. So why? Number one, we don't own any government securities. So we view governments, as I said earlier, as being something that just doesn't yield enough. The risk just isn't worth the reward right now. And until governments have a higher yield or we start worrying even more about recession, we're not going to own governments. So potentially governments are a story for us maybe sometime in 2019. As I talked earlier about the credit cycle, we prefer investment grade credit right now. And although I pointed out the fact that credit spreads are really, really narrow right now, the fact of the matter is that because the Bank of Canada has raised rates 3 times, we're getting 75 basis points more interest rate lift now than we were a year ago. So we're getting paid way more. So consequently, we can buy investment grade credit in the range of 3 years to 5 years that yields somewhere between 3 and 4%. That's a lot more than what we could have returned or what we could have got from investment grade. So we like investment grade a lot more now. The other thing that we've been buying, I talked a little bit about preferreds earlier. We've been selling down a lot of our preferreds that we bought a while ago that had bigger floors and were paying a higher rate, primarily because they've all rallied and they're trading well above par right now. So what we've done is we've recycled some of that cash into the older rate resets and into floating rate preferreds. And the reason that we've done that is because we look at those securities as having negative convexity. As the Bank of Canada raises interest rates, we're going to get paid more on these preferreds, and they'll move from a discount to $25 up to $25 and above. So in addition to collecting a good coupon on these, a good yield on these, we'll also capture some capital gains in them. We also like floating rate securities, and we haven't bought floating rate in a little while. We've added a 10% weight of floating rate securities to the portfolio, again, because we look at them as being negative convexity. As the Bank of Canada raises interest rates, we're going to get paid more and more on these floating rate securities. So floating rates now yield 3%. If we're right and the Bank of Canada raises rates another 2 times this year, we'll be getting paid 3.5% on floating rate notes. So we think that's a great place to be. As I've talked about the yield curve and where we think the business cycle ends, we think high yield right now is really, really expensive, and we also think it's a security that we don't want to own a lot of because we think it's particularly vulnerable right now. So we've really reduced our high yield, and we've replaced it with investment grade, and we've also added cash to the portfolio. So our liquidity now is up to about 20% cash, and what that consists of is primarily short-term bonds and BAs. But again, because the Bank of Canada has raised interest rates on 3-month BAs or short-term corporate bonds, we can get paid 2% or better now, which is a lot more than we could a while ago. And then the other thing that we've done and that we're doing more of is, and we think this is very, very different than any bond funds are doing out there, is we're now doing options on big liquid ETFs like HYG, which is the high yield index, LQD, which is the investment grade index, or TLT, which is the long duration bond index. So we're using options on these ETFs to add some tail risk risk hedges to protect us against either rising interest rates or adverse movements in credit. So any way we can add insurance to the portfolio that as interest rates go higher, we get paid on these options positions. We've initiated some straddles against that, and we've also done some hedges to protect us against corporate bonds moving down in value or as volatility increases in credit. And again, our thesis is as interest rates move higher, we're going to see more volatility. So I think we're going to have, as I've said, we're going to have higher interest rates. And to summarize, the Bank of Canada is probably going to go 3 more times, bringing the bank rate to 2% this year. 3 times in total, 2 more increases this year, bringing the bank rate to 2%. 10-year interest rates are going higher, probably 50 basis points higher. We think the Canadian dollar is going to be stronger, and we think the yield curve continues to flatten. So our expectation is a recession in probably late 2019 or early 2020. And with that, high yield comes under pressure later this year. Retail investors, with this move higher in interest rates, sell out of fixed income ETFs and mutual funds. We continue to like investment grade because we think it will benefit from higher interest rates, i.e. as interest rates move higher, we'll get paid more on investment grade credit. So we'll continue to add investment grade throughout the year. We like, as I explained, floating rate securities, so we'll add more floating rate securities. And we'll continue to add options tail hedge positions to mitigate our credit volatility and interest rate risk. And the last thing is our expectations this year are probably somewhere between 4 and 6% after fees. And if we think that's probably very doable with a portfolio that's constructed like this, and especially if we continue to be very active in keeping low duration. Thank you.